Welcome to the deep dive. You're looking to get smart, fast, and today we've got a really different way of looking at the economy.
That's right. We're stepping away from the usual indicators for a moment. We're actually going to talk about, believe it or not, men's underwear sales.
Men's underwear. Okay, I have to admit, that caught my eye. Our source material today looks at this very idea. Can underwear sales predict a recession? So the big question is, can they? Really?
Well, it's this concept called the Men's Underwear Index. It got a lot of attention thanks to Alan Greenspan, the former Fed chair.
Greenspan. Okay, interesting. So what's the logic there?
It's actually pretty straightforward. The thinking goes that when economic times get tough, men tend to postpone buying new underwear.
Right, because, well, nobody really sees it, I guess.
Exactly. It's a private purchase, easy to delay when you're trying to save money. But then, when the economy starts looking up, sales tend to rebound.
Huh. So it's like a hidden signal. The source actually gives some examples, doesn't it?
It does. During the 2008 recession, there was apparently a pretty noticeable drop in sales in the U.S.
Okay.
And then things picked up again after 2010. We saw something similar, though maybe faster, during the 2020 pandemic.
A drop and then a recovery in 2021.
Yeah, as things started to stabilize a bit, it seems to track, at least anecdotally.
So why does this actually matter? What's it telling us? Is it about psychology?
I think that's the interesting part. It taps into consumer behavior during uncertainty. Putting off buying underwear is a small thing, right?
Sure, seems minor.
But it might reflect a wider pattern of cutting back on discretionary stuff, especially things that aren't public-facing. A kind of quiet austerity.
My personal belt tightening, literally almost. And didn't the source mention other weird indicators too? Stuff that seems unrelated.
Yeah, a few others follow similar logic, like champagne sales dropping might signal a downturn.
Because people celebrate less.
Presumably.
Or less demand for cardboard boxes, meaning fewer goods being shipped. There was even mention of skirt lengths, the hemline index idea. Right, the hemline theory. Longer skirts in bad times. That one's been around a while.
It has. Now, it's really important to stress, these aren't crystal balls.
Definitely not standalone predictors.
No way. But they offer a different kind of insight, maybe capturing shifts in mood or behavior slightly before the big economic numbers do.
Like the source mentioned, seeing more packed lunches in the office fridge, that kind of thing.
Exactly. Anecdotal signs of frugality, but, and this is the key point from the source.
You can't just look at underwear sales.
Absolutely not. Economists rely on the hard data, GDP, unemployment, inflation, all that traditional stuff for the real picture.
Yeah.
These quirky ones are supplementary.
They add a bit of human texture, maybe, that balance between cutting back and allowing small comforts.
That's a good way to put it. They show the human side of economic ups and downs.
So the main takeaway for everyone listening is the men's underwear index isn't going to tell you exactly when the next recession hits.
No, definitely not.
But it is a fascinating, kind of strange window into how people react financially, adjusting even really personal spending habits when things feel uncertain.
It really is. And it makes you wonder, doesn't it? What other everyday things, seemingly insignificant purchases we all make?
Like coffee or streaming subscriptions, maybe.
Could be anything. What shifts in those habits might tell us about bigger economic or social changes if we just paid a bit more attention. Something to think about.
For detailed discussion on this and other important economic topics, visit our YouTube channel Business World. Business World, your business partner.